mean and how you profit from them. Remember, if the underlying stock here, in this case EDU, goes up, this option will increase in value. Let's say it goes up $5. It's currently at $75, and if it goes up $5, what will happen to the price of this option? Well, what will happen is that if it goes up $5, we can take a look at, now the stock is at 70 or 85 rather, instead of 75, or no, I'm sorry. It's currently at 75. So it goes up $5, it's currently at $80. Then that $1.85 option will go $5 further into the money, and it will be worth approximately $4.10 because it's $5. Right now the stock is at 75 and the 75 call is at $4.10. If it moves up $5, then that call will now also be worth $4.10. That call will be now, the 75 call will move up and it will be worth $7.30. So that's why people buy call options, because if they believe the stock will go up in price, they will profit from it. So why do we do spreads instead of buying single calls then, or single puts? The reason is that our risk is a lot less. For example, if we were to purchase this call option for $1.85, if the stock moves against us and the stock actually moves down instead of moving up, now let's say it moves down by $5. Now what happens to our call option? Well, now it's only worth 70 cents. We've lost $1, almost $1.10, $1.05 of the option price. That's almost 50% of the option price. So normally what we like to do is create what we call spreads. And a simple spread order is simply the purchase of one option. And what we need to do here is, in order for me to show you this, we need to select the Advanced Order tab from Single Order to Blast All, just so that we can show all of the options that we're purchasing. Here, let me show you what happens if you have it on Single Order. We can buy that, and then let's say we want to sell this one. Well, it just changed it. We didn't give both of the orders in there. So we need to change this to Blast All. And then what we're going to do is we're going to create a very simple vertical spread. A simple vertical spread, let's say we take the 75 call, we buy that, and in order to protect our investment, we want to sell an option at a strike price just higher than that. And this is called a vertical spread. We're buying one option, we're selling another, and that will protect us, okay, from a downturn in the market. Because what will happen is if the price of this option, if the price of the underlying stock goes up, this option that we purchased, the 75 call in this case, will increase in value greater than the one that we sold, in this case the June 80 call. We sell the June 80 call and we'll make money on the June 80 call if the market goes down, and it will help protect the price that we paid for the 75 call. We'll still lose money on this position, but we won't lose as much as if we had just purchased the 75 call alone. And if the market goes up in the direction we anticipated, then the 75 call will increase in value greater than the money that we've lost on the 80 call that we've sold. So let's take a look quickly at this particular spread. We're buying one call, we're selling one call. The difference in this, I should remind you, this is in the same month, this is in June. And the strike price of the one that we're buying is 75. The one that we're selling is 80. The difference between these two is 5 points. So this is considered a 5-point spread, vertical spread, 5-point vertical spread. The vertical means that it's in the same month and in the same option. Okay, they're both call options. Now, if we were to take the $4.10 and subtract it from the $1.70, because we're selling that one, we're actually receiving a credit of $1.70. We're paying $4.10 for the call option, but we get a credit of $1.70. If we subtract those two, that is what we pay as a debit for this particular spread. So $4.10 minus $1.70 is $2.40. That's what we would pay to put this spread on, this vertical spread. It's also called a bullish vertical spread because we are making a directional play here. We are anticipating that the stock is going to go up. So this 75 call, this 80 call, it's a $5 vertical spread or a bull call spread, and that means that if, in fact, the stock does go up, we will make money. How much money will we make? Well, we just calculated the difference in these two prices, and it comes to $2.40. The difference between the strike prices is $5. The difference between the $5 strikes and the $2.40 that we purchased this spread for is $2.60. $2.60, if we hold this all the way to the expiration in June, is the maximum amount of money that we'll make on this spread. So you can see that vertical call spreads are, their advantages are that we protect our long call with the sale of another call above the strike price, and that helps to bring in a little bit of premium because we're paying $4.10 for this. We're taking in, we actually get this deposited into our account, the $1.70 into our account, making our net debit here $2.40 for this spread that can be worth $5 at expiration. So our maximum profit is $2.60. So, like I said, we have a spread here that's $2.40. Now, our maximum profit is $2.60. But for us to enter these positions individually, we're paying basically the retail prices. We're collecting the $1.70, which is the bid price. We're paying $4.10, which is the asking price. So the $2.40 for this spread is the retail price of this spread. Let me close this out for a second. Remember the $2.40 it costs to put on this spread. Just remember that for just a second. Instead of entering those orders individually, what we can do is right-click on the option that we want to buy, go over to Buy Vertical, and we can see that it brings up both the option that we want to buy and the option that we want to sell in the same order entry box. And now we can enter this order as a spread, and the mid price is $2.20. The natural price is $2.40. Remember, the $2.40 was the amount that we had entered, the amount of the spread when we clicked on each individual option. So we have the option, though, when we bring these up as a vertical spread and enter this order as a spread rather than individually, we can actually have the opportunity of purchasing this spread for $2.20, which is the mid price between these two set of options, saving us 20 cents on this particular option. Now let's just, for an example, we're only using one contract here, but let's go ahead and confirm and send this and bring up that dialog box. It will cost us $240 if we were paying the retail price, which is the natural price for this, plus a $3 commission, and it will cost us $243 to enter this order. As I mentioned, if we're paying $2.40 or $240